What's up, traders? Anthony Crudele here, and thank you for tuning in to the Futures Radio Show podcast. In today's episode, I'm joined by David Cervantes, the founder of Pinebrook Capital Management. David is a seasoned systematic strategy manager and macro analyst, specializing in the business cycle, macroeconomy, and policy reactions. Join us as we explore David's insights on key economic indicators, interest rates, and the upcoming earnings season. We'll also delve into the recent performance of small caps, his outlook on equities, and advice for navigating the current market conditions and this macroeconomic landscape. Let's get started. Today's podcast is sponsored by FTSE Russell and TradeStation. FTSE Russell is the home of the Russell 2000 Index. Did you know that with an 81% share and $1.5 trillion in institutional assets benchmarked, the Russell 2000 is the top choice by far among institutional investors? Like all U.S. Russell indexes, it's rules-based, transparent, and reliable. Regularly updated with the latest IPOs and annually rebalanced. To learn more about FTSE Russell and their products, please go to FTSERussell.com. As a futures trader, you can leverage your portfolio even more thanks to TradeStation's reduced margin rates across popular futures products. Enjoy intraday rates as low as 10% on select U.S. index futures. TradeStation is also cutting margin rates in half for popular energy products, crude oil, heating oil, gasoline, and their associated minis. Open an account today and access over 600 CME Group futures products and customize your trading strategies on a sophisticated platform built for advanced traders. Go to tradestation.com/Anthony to learn more. David, thanks for coming on the show.
Hey, thanks for having me. Happy to be here.
Great to have you. I got introduced to you on Twitter. Of course, I feel like all my guests come from Twitter. I almost don't have any guests that don't come from Twitter. I started following you on Twitter. Love your work. You got a Substack. We're going to focus on the macro side of things today. From the macro side, how much really does the president even matter?
Well, I think it matters, but it's hard to trade, right? Because what the president does is, he's got policies he wants to advance. Could be on the fiscal side, could be trade related, and these things take a lot of time to put into motion. And I think it's hard to trade that. I think investors are better off focusing on, what's happening today with the growth and inflation matrix, and try to understand how that's going to affect the next 2 to 3 months. So, I think, looking ahead, it's something to position for sure for allocators, but I think for traders, it's really hard to monetize political developments. I don't even try it, honestly. It hasn't worked for me. Maybe it can work for some people that can handicap these things, but I'm not one of those people.
Yeah, and I started off with that because so much energy out there right now when it comes to the indexes, which I mostly trade, and even when it comes to, bond markets. I always have felt, for doing this for decades now, that the president themselves never seem to matter that much. I mean, obviously policy matters. As an American, it matters, and all of those types of things, of course. But when it comes to the way I trade or invest in the market, it typically has this initial surge where you might see something come in that matters. Like after Obama, I thought maybe there was something to do with crude oil. There was a trade there. Even Trump, I thought oil a lot of times is a good trade. But for the most part, it never seems to be anything that has legs. I just wonder what your thoughts are on that.
No, I think you're absolutely right. I think these developments take time to work out. If you focus on what's happening today, there's a lot more scope for profitable trading. For example, right now we're in the beginning of a Fed cutting cycle. Markets have priced in a cut for September. Markets have priced in, anywhere between 4 and 6 cuts for between now and the end of next year. And, I think it's easier to focus on how those developments are going to play out and where the trade is embedded in that, as opposed to, politics. Politics is just such a wild card. The outcomes are really hard to handicap. We can have a reasonable idea and build assumptions on what we know around our portfolios and put trades on around that. So, good example, for example, is, with the cutting cycle that's starting up, what's the trade there? What are the interest rate sensitive sectors that could benefit from that? I'd rather focus on that than on the election, which I have no clue what's going to happen there. But I can tell you when rates start getting cut, there's going to be movement in asset prices. And again, some of that's priced, future developments that will, really kind of unfold as the data unfolds. Yeah, that's the way I approach that problem set.
Yeah, I think that's a clear headed way to approach it. And that's one of the things I love about your work is, I've only been following you for a short period of time, but it's very clear. I think I get a really good grasp of what it is that, you're looking at in terms of how your investment approach is and when, just really the way you see the markets. Was reading your Substack, and one thing I wasn't a little clear on, and it's one of those things where I understand the terminology. Something was saying was like cautiously optimistic on risk assets.
Yeah.
And it's funny because I actually do feel a similar way, but it's one of those things where what does cautiously optimistic mean when you're looking at risk assets? Let's start there.
Yeah, it means that, first and foremost, the growth cycle in the economy is still on. The economy is still expanding, and you're going to have follow through in asset prices to reflect that. So that's a good thing. That's the optimistic part. The cautious part is, we've had such a massive ramp since November 1st of 23 last year that pretty much everyone's raising their targets with the S&P 500 just to keep up with the price action. Everyone's adjusting it. Everyone's late to the trade. No one's called the numbers now that we have now. I think 5,600 was something that was being looked at earlier this year. We blew past that. We pulled back a little bit in the last few sessions. But for the most part, everyone's raising their prices to keep up. So there's always that element of like, oh my God, could there be a pullback? And that's just part of the business that we're in. Yes, there are pullbacks. Yes, there are corrections. I don't think we're set for a correction personally, but a pullback, is just part of the gig. When I say cautiously optimistic, I mean, asset prices are subject to a lot of noise, a lot of, just volatility spikes. Could be, geopolitical, could be political on the domestic side here. It could be, one bad inflation print could throw things off. But for the most part, asset prices will continue to keep going up and reflect the growth of the economy. So that's my view on risk assets.
Yeah, and when you have so many people out there right now really trying to be negative, I think that you have so many. I see a lot of macro traders out there trying to be defensive in their tone because I think most people do see a very optimistic future for risk assets. But like you said, you have to be cautious. Also, we've come a long way, I think, in a short period of time. Watching these indexes over the years, I feel like this is one of the strongest bull markets, honestly, I've ever traded. I don't remember a bull market, honestly, as strong as I've ever like this. Have you ever had one like this before, David?
I came into the business in '98, and my first impression in financial markets was, the go-go years, the late '90s, the dot-com craziness. And I honestly, from a market standpoint, we're nowhere near that kind of euphoria. What I saw back then was just absolutely bonkers. And in terms of the economy is much more balanced, much more stable. I think the economy is on much better footing than it was in the late '90s. In the late '90s, you basically had a massive concentration in financials and tech. A lot of that tech was debt fueled. But here the economy is really much stronger. What I mean by that is the labor market. We're pretty much at full employment. We're pretty much, if you want a job, there's a pretty good shot you're going to go out and get a job. You can get a job. May not be the job you want, may not be the job you dreamed about, but you'll have a job and there will be cash flow. And that's what matters for an economy. So, this is the strongest labor market we've had in over 40 years. So right there, that tells me that the cycle is strong. And to your point, that this is a massively strong bull market. This is not a bull market I want to be shorting. Do I want to be careful about when I get in or just have a kind of a longer view to write out some volatility? Sure. But this is an epic bull market, hands down. I haven't seen something like this in 25 years.
Yeah. And I started right around the same time. I started in the mid 90s, and no doubt that market was, I guess this one I look at as stronger as an overall sense, but that market was the most unbelievable in a sense too, because you came from a time where really stocks just didn't move like that. Indexes didn't move like that. I remember being in the S&P 500 and we used to joke when we were watching the Dow, every time the Dow would tick up, we felt like it was going up 500 to 1,000 points every month. I remember when they first hit 10,000, next thing you know, everyone's like, oh, when's 20,000? It just became exuberant. Like the market just became, basically linear to the upside, which we all know what ended up happening at the end of 2000. This market is, and also the biggest difference too, David, and maybe you touch base on this. Back then, you could almost throw a dart at the wall, buy a stock, and it would go up. I remember one of the stocks I bought was like eDig. Some people might even remember this one. It was like
I do
eDigital.
remember that.
I was just like
Yeah.
randomly picking stocks. TiVo.
Yeah.
Nowadays, if you look at as we're recording like today, Crowd is down another 13%. Even some of these names, these popular names, look at what Tesla did earlier in the year versus to where it is now. The indexes fought that off. And so internally, we're not seeing that throw the dart at the wall type market, but we are seeing the indexes for the most part really stay so strong amidst even I think when you look at a stock market that's not really, like I said, that throw a dart at the wall and stock go up.
So I think the big difference between then and now is, and this is kind of wonky here, but the big difference is volatility. Volatility is structurally lowered, and that comes from the Fed put is better telegraphed, so investors have a better idea of what the downside floor is. The business cycle is actually gotten longer. Back in the 80s and 90s, you got the recession. You had a recession in 91, then you had some weakness in 95, and prior to that, you had the 87 crash. There was a lot more drama in markets, and now, really after the global financial crisis, we've had a giant expansion. I mean, some people would even argue that the COVID was kind of a fake recession, right? It was kind of this outside shock, and then we threw the kitchen sink at the problem and fixed it and moved on. Viewed through that lens, this is insanely long expansion that started basically in 2010, let's call it. So now we're looking at basically a 24-year long expansion. That's kind of like a new era, so to speak. I'm not saying it's we've the old saying we've reached a permanently high plateau in stock prices. Just that was those were words that were mentioned right before the crash in 29. But I do think that the business cycle has gotten a lot less volatile. The policy making cycle has gotten a lot less volatile. And I know people like to hate on the Fed, but they're actually doing a much better job than they've done in the past 20 years. So what that means is with lower structural volatility, you're going to have a lot more investor confidence in markets. You're going to have less crashiness and more just kind of a steady Eddie grind up, kind of like what we've seen for the past 24 years. It's a great time to be an investor.
What would make you bearish?
I would think the central bank would have to lose credibility on the inflation front, and a lot of people threw rocks at them being late to inflation in 21 and calling it transitory. But at the end of the day, viewed through the lens of the big picture, they did a pretty good job. Once they realized that they had to really kind of get this beast under control, they went at it and attacked it with the most aggressive policy hikes that we saw since Volcker. Jerome Powell had his Volcker moment, and he went after it and did not even care. Obviously he didn't care, but the policy focus was getting inflation under control, and they did it pretty well. Inflation peaked. Gosh, I don't have my charts in front of me right now, but the inflation we started getting the disinflation around 22. It was not a long time that the sense of inflation kept on going up, and so that would make me bearish if they really just kind of threw out the mandate on the inflation front. The other thing that would make me bearish is how they approach the problem set. Right, the problem 2 years ago was inflation. They were focused on that. Now the problem is not so much inflation as it is protecting the gains in the labor market. So what would make me bearish now is, really is, do they say, okay, we're going to let the labor market and the gains that we made in the labor market get away from us? That would make me bearish, because that's kind of, once the labor market goes, then a recession is pretty sure to follow. And I don't think they're going to do that. I think they're going to continue to prioritize now with inflation, for the most part, a done deal in my view. And apparently, in their view, it's just a matter of time. They're going to focus on the labor market, and they've got their eye on that. So I'm not bearish because I think they've got the policy aligned with the appropriate environment that we're in.
Again, David, two clear points as to what would change the way that you look at markets. And I think that they're really easily followed by other traders out there to help them along their way as well. I want to go back to your Substack and talk about another thing that you've talked about when we stay on the Fed here. You talked about really this is a controlled slowdown, or they've nailed the soft landing. And so it appears to me as though you think the Fed has done a pretty good job, because a controlled slowdown or a soft landing, I guess, essentially pretty much kind of the same things ish.
Yep.
And so the Fed, you believe, has done a good job. And so you think that this is where we are and where we're headed.
The answer is yes. I mean, we're in a Goldilocks environment. Well, what I mean by that, well, inflation continues to come down, and the labor market has softened a little bit, but not in anything that resembles, head toward a path of recession. So right now we're in a sweet spot. And I called the soft landing back in November of last year in my Substack, and it made some heads explode, but for the most part, it's held. What does that mean? It means that the economy continues to expand, inflation continues to come down, and the gains that have been made in the labor market have been protected. We're still at full employment. So, it doesn't get any more soft than that in terms of a landing or a slowdown or whatever. They've really nailed it. Some people could say, well, inflation is going to come back up, or this could happen, or that could happen. Absolutely correct. Those things could happen, but they haven't happened. Been pretty much, we're getting close to a year since they pivoted in their policy, calling off the hikes, saying we're going to start cutting, and none of the bad things that were supposed to happen have happened. So if that's the case, then we just got to call a spade a spade. We've soft landed.
So you're in the camp that we're going to get rate cuts, I think, relatively soon, kind of if I read the tea leaves in your Substack. Do you think that's why small caps have gotten a recent bounce? And also just talk about when you see cuts and the impacts maybe beyond small caps, because I think that's kind of the one that everyone realizes that once those cuts take place, it's probably going to give them a lift. But what do you see beyond small caps?
We'll start with small caps briefly. Small caps, I think, is really more of a catch-up trade. The catalyst is the cutting cycle, but I think small caps for now are structurally going to underperform. In other words, we'll get a bounce just because the big caps have done so well in the past 9 months, and there's been a massive underperformance gap, and that's just it's kind of more of a close the historical spread kind of thing. But the earnings power of large caps, which are very tech concentrated, a lot of small cap names just don't have a prayer of even matching those kinds of margins and that kind of scale. So I think small caps, after the rotation trade is done and asset allocators have kind of rebalanced their books, I think small caps will continue to underperform as they have for the past decade and change. Moving beyond small caps, the other interest rate sensitive sector that I look at, and I think will catch a bid soon, will be the housing market. Housing is very interest rate sensitive. Fixed residential investment should pick up as mortgage rates come down, and we should see kind of a resurgence in building activity. So I think in terms of a trade, in terms of a sector to look at, is definitely the home builders. That really caught a strong bid in 23 last year. They've been consolidating for the past 6 months. Nothing horrific, but in the past week, they've really caught a bid as well. So that's an area that is primed to bounce along with the cutting cycle. Additionally, I'd say the small cap banks, the smaller financials, KRE, those should also do well as well, since they're pretty highly levered to the interest rate cycle.
When do you see the Fed first starting to cut rates?
September. That's a pretty consensus, non-controversial view. I think what could introduce some controversy is, talk of a 50 basis point cut. Now, that's not my base case. I don't think we're gonna get that, but that doesn't matter what I think. What matters is, how do markets respond to new information, and how do you get ahead of them to make money? When I look at these things, it's not, oh my God, I think they're going to cut 50. I'm going to put a bet on, and hopefully they cut. And if they don't, I'll lose money. So that's not the way I do it. At least it's more of like, okay, here's where I think the puck is going. I'm going to position for it, And hopefully I can catch part of that movement. And when I do, I'll get out. And where it ends, I really don't care, as long as I was able to monetize part of that view. There's just no perfect way to trade these markets. They all involve an element of risk. So the way I control my risk is, I set a threshold of profits I want to capture or hopefully capture, and then get out, and not become religious about where the puck ultimately ends. I think a lot of investors, or traders more really, that focus on, the terminal point of the puck is where they kind of get in trouble, because first, it's never a straight line, and second of all, that cannot be determined in advance. We can make guesses and take gambles, but where the marble ends up on the roulette table is unknowable until it stops.
No, absolutely. But right now we're at 5.25. How low do you think that the Fed will take rates, and in what time frame do you think it'll take for them to get there?
Yeah, so just kind of building on the same logic, I honestly don't know how much they're going to take rates, and that's going to be subject to, the rate of growth of the economy and the labor market and inflation. So, if the labor market starts to deteriorate quickly, then I think whatever is priced in will not be enough, and more cuts will get priced in. Conversely, if the labor market starts to firm up again, growth starts to firm up again, then they might have to take some off. So I think that's the way I view what the Fed is going to do. It's really that's why they call it a reaction function. The Fed is no better a forecaster than you or I or anybody else. They got the smartest people in the room, the biggest research budget. At the end of the day, they're also making a guess. They're also winging it. They're also making it up as they go along. But they have a reaction function. They react to the data. So I think what's more important to focus on is not so much, can I front run the data? It's, can I front run the reaction function? Can I beat the Fed at its own game? I think that is a better way to approach the problem set than the data a year out no one knows about. I have no idea what the labor market's going to look like in 8 months. I have no idea what inflation will look like in 8 months. I have a guess, but ultimately the Fed's going to react to that data as that data comes out. And so I just want to front run the Fed and anticipate the Fed's moves based on my understanding of growth, inflation, labor market, and what the Fed's objectives are.
One of the things you mentioned earlier when I asked you what would make you bearish, you said it was the Fed losing credibility. In the rate cutting cycle, would them cutting too much too soon be one of those things?
No, I think to lose credibility, you need to get expectations unanchored. I mean, it sounds kind of wonky, but you basically need to, inflation swaps and the yield curve have to start pricing in inflation expectations that are above the norm or whatever. So I think for now, those expectations are pretty well anchored. If you look at, 10-year inflation swaps, they're not moving much, or even break evens. They're not moving a whole lot. So I don't think we're there. That would be something that would make me bearish if we got there, but I don't think we're nowhere near there.
Talked about labor, talked about inflation data. What other economic indicators are you looking at to predict the next moves of the Fed?
So I look at the housing market, specifically fixed residential investment. There's an old saying: the housing cycle is the business cycle, and the housing market, fixed residential investment is only around 4% of the economy, 4.5% of the economy, but yet 7 out of 11 post-war recessions have started in the housing market. Why is that? The reason is it's highly levered to the business cycle via the interest rate channel. So what happens in monetary policy, it really transmits really quickly and pretty efficiently through the housing market, which makes the housing market very volatile. So when you start seeing a slowdown, or if you want to anticipate a slowdown or an acceleration of the economy, look at fixed residential investment, because fixed residential investment is first in, first out. It's a leading indicator, and it gives you a really good idea of where the economy is going to go. And you kind of gloss over it, but I'll get back to it, which is the volatility of the sector. When that area starts to really ping around and get volatile, then that introduces risk into the business cycle. So to answer the question, it's fixed residential investment, and specifically construction employment and construction spending. Those are really key indicators to understand the near term, 2 to 3 months, 6 month out movements in the economy, I think.
I want to stay on housing just for a second. When we start to see rates come down a little bit on the long end, which obviously when then we see the mortgage rates come down a little bit, Do you worry that because we've had such a I'm in Florida, so in Florida we've had such a tremendous run higher. My wife's actually in real estate, and slowly but surely we're starting to see supply creep up. I'm always picking her brain and saying, what's going on, in the market, and just keeping an eye on it. Even though I'm a market guy, my wife's a real estate person, so I kind of play off that a little bit, similar to what you're discussing. Is why I think it's a good economic indicator. I'm seeing supply continue to come on, even with rates down ticking. I'm not seeing stuff sell. Do you have a concern that even though rates start to come down as a positive for the buyer, that supply might just hit too hard and ultimately drive housing prices lower? Wouldn't that kind of work against as a positive economic indicator?
Yeah, so what I look at really is not so much supply, because the market's going to clear at some point, right? At some point, the market will clear. And I think a lot of these supply concerns are driven by other factors, like, I know insurance is becoming a problem. There's a lot of houses that just can't be insured because the insurance market, and I heard Florida is one of those spots. The insurance market has really got some wonky things going on that they're above my pay grade, but I know that they're a problem. So that's going to distort things. And I think what's also going to distort things too is people just don't want to move, because if you have a lot, if you're an older person on a fixed income, you want to downsize. Do you want to give up your 2% mortgage for a 7% mortgage? Probably not. So that's going to just introduce some distortions. I think it's more useful to look at actual economic activity. So, housing sales in and of themselves don't really do a whole lot for the economy. It's a simplistic way to look at it, but you're basically just switching paper, right? You're going to a title company and registering, things, and maybe you'll do a kitchen. But for the most part, the real juice from economic activity comes from, new single family residence construction. That's really what makes its way into the economy. The actual building of a home, which has an insane amount of inputs through the supply chains that go into building a house. So whether it's lumber, whether it's new appliances, whether it's, whatever, windows, all that kind of stuff gives you an insane amount of bang for buck in terms of economic impact versus switching paper between buyer and seller. So I think it's more useful for understanding the economy. It's more useful to look at those metrics. I think the inventory things are just kind of more of they're not causal, they're more residual to other activity, but it starts with the actual construction.
I'm glad you pointed that out. That makes a lot of sense to me. I mean, so it's basically the new home sales is the number that's more of a focus versus existing homes.
Correct, because again, the existing home, you're switching paper. I buy from you, you buy from me, and again, maybe somebody wants a new bathroom or a new kitchen. So there's some economic value added there. I mean, it's just, again, there's a lot more nuance in the way I'm presenting it. It's very simplistic, but for the most part, this is kind of really the way it works in the economy. The way when a new home is built, not only is there spending associated with the materials I mentioned, but think about the labor. Think about all these, folks that, roofers, framers, plumbing people, foundation people. Think of all that money flowing into these people's pockets every week. So these folks are paid weekly typically. So think of how that happens versus I buy from you, you buy from me, whatever. We switch some paper. How many people are employed in doing that? Maybe a realtor, maybe a title appraiser company, but it's a handful of people versus when you got a new house going up, you got dozens of teams going up, putting a house up. So it's not just the supply chain, it's also the labor chain. And that goes back to what I was telling you about how important it is to look at the construction employment activity as an indicator for the forward path of the economy, because that really, again, it's spending, it's money going into people's pockets. These people have families. A lot of these people are paid in cash. They go out and they spend it Friday. They go out and spend it, and they pay bills and enjoy the residual from that. So that is a lot more bang for buck in terms of looking at the economy.
Yeah, I know it ties into your overall theme. I totally see that and understand that. Well, we're in another earnings season, David. I feel like we come out of one for like a few weeks, not even, and we're right back in the heat of it, right? And
Yeah.
so it seems like it's one of those things where we're always in earnings, but nonetheless, I've talked with a lot of macro traders so far this year, and as of late, I mean, Bob Elliott, probably pretty sure you know who he is.
Yeah, I know. Bob. Yeah,
great guy.
Absolutely.
And
Yeah.
and Bob pointed out to me in a recent show. He's like, Anthony, he's like, it's really not about the Fed anymore. He's like, it's really so much more about earnings projections. I mean, that's what's getting people to come in and take the market higher, even chase the market higher and to chase the indexes. So here we are at the beginning of earnings. First, maybe I'll let you comment on what Bob had mentioned there. But we're getting into earnings, and what are we looking at here? And do you feel in similar thoughts as to what Bob mentioned, that it's more about earnings projections than the Fed right now?
I mean, ultimately, it's always like that, right? Because if you go back to the indices
It
and
should be, David. Right?
earnings from 2018 till now, earnings are up roughly 55%, and the market's up roughly from 18, roughly 53%. I don't know, whatever. It's at the margin, but effectively, it is always that way. It's always in the near term where everyone's trying to handicap what's going to happen, but for the most part, it does really come down to earnings, and that is, that's just the way it works. So my view on earnings right now is, a lot of earnings are higher growth rates than normal are priced. But why is that? Well, at the aggregate, why is that? And you can make the argument of, well, it's a narrow breadth market and blah blah blah. But what matters for investors is what's happening in the aggregate, and the aggregate, whether it's Mag 7 or it's widening, whatever, those earnings are going up, and we cannot deny the basic accounting, the basic math behind those increases in earnings. These companies have massive scale, incredible margin pricing power. And that goes back to my point I was making earlier about the small caps. It's like the small caps, they can't compete with, Meta or Apple or whoever. They can't do it. They don't have that kind of global reach. They don't have these insane margins. And, going back to the indices or the large cap indices, that is what the market is focused on, is what's that bottom line number. And I think a lot of people just don't appreciate what that bottom line number has potential to do as a function of the unit economics of these companies. It's kind of makes some heads explode, but the earnings ultimately are coming in.
Yeah, I mean, look at NVIDIA. Yeah, I'm not a stock trader. I'm an index trader. And when I saw NVIDIA's earnings, I mean, I own it in my portfolio. I was like, man, they just keep beating. They just keep beating. And it's just incredible what they've done.
It is absolutely bonkers. And I think, I am by no means an AI specialist. I'm just scratching the surface here. But, one thing we don't appreciate about AI is how AI is building on itself, right? Meaning, I'm not saying it's got consciousness or that it's a person or it's going to be a person, but think of it this way. My understanding is that, NVIDIA's next generation of chips are being built by its own AI technology. So the engineers themselves are even keeping up with their own technology. I mean, it is, if you think about that, it's wild. Basically, what you have there then, if you can have your AI power your future development, you have a license to print cash. Why is that? Because you don't have to pay engineers and you don't have to wait 3 years to develop something. Because so AI, all it is, it's not, I don't think it's the magic, Kool-Aid to economic nirvana. But what AI is really ultimately is just it's a time accelerant, and time is money. So if you can find a way to use AI to accelerate time, then there's money to be made. Think of it this way. Another case study, biotech, right? The lead time development for a new class of drugs was notoriously long, right? First you had the basic science, then you had to run tests, then you had to go through FDA approvals. So the timeline for developing a set of drugs was, sometimes decades long, right? Or not decades, but close to a decade long, right? So what AI is going to do is, first of all, it's going to accelerate that. So you no longer have that same development lead time. And then AI will be able to basically simulate a lot of what these drug trials used to take, years to do on the human body. AI will now be able to simulate it. I mean, that's crazy when you can accelerate time. Now you no longer have a 7-8 year development time on a drug. Now you can knock this thing out in 2 to 3 years. Just think of the unit economics and the productivity that's going to happen. I don't think AI is going to, put the whole world out of work, but I think on certain high value, it will have some high value best uses. And if we just listen to what Jensen Huang is saying about how their own new technologies are being developed by their AI, that's just a template for how this will be applied through other parts of the economy. So I really don't. I think we're scratching the surface of this here, and I think there's going to be a lot of heads exploding as we see a lot more implementation of this technology to accelerate time, and time is money. So if we can accelerate time, we can make money.
Very well put, and I agree with you on that. I think it's such an interesting time. Like you said, we're just scratching the surface on it. Couple things before I let you go. To the traders out there that aren't using macro, I was one of those traders for years. I start to use it more and more now because I need to understand an overall theme. You put out a very clear theme. How can traders out there that aren't using macro, or maybe they are reading it and hearing about it, but they can't actually put it into play, put it into work, talk to them? How do they do it?
Yeah, the best near-term use of macro is not so much in picking the next movement in interest rates. That's pretty hard to do and do well consistently. I think the best use of macro is to understand your own risk management. When is the time to take risk? When is the time to lard up on leverage? When is the time to be risk off? Understanding the Fed put, understanding the growth cycle, the inflation cycle, that will really help you sleep at night a lot better. In other words, I'm a pretty cautious person by nature, so my understanding of macro helps me gauge how much risk to take, how if I'm shorting volatility, how aggressive do I want to be in doing that? Is the Fed put? What's the strike on the Fed put? At what point does a fall in risky assets get the Fed involved to backstop the fall? That helps me understand how aggressive I can be in any given activity. So I think it's really just more of understanding the temperature of the market to help you make your decisions is really the best in your use of macro. I mean, if you want to get really into the weeds and try to forecast interest rates, it can be a tool for that. There's other things that need to be considered, but really that's, in my view, the best use of macro is understanding the basic environment that we're in.
Well, David, you put out your macro view in your Substack. I've read it. It's great. Why should listeners out there go and subscribe to your Substack?
The answer is I keep it pretty tight and short. In other words, I don't produce long reports because my view is people running real money don't have the time to sit through a 40-page report or even a 20-page report. It's got to be digestible. It's got to be something you can read over a cup of coffee in the morning. The human brain can't process a whole lot of information at once. So brevity is point number one. Two, I think, is clarity and focused on things that really, really matter. And there are not a lot. It's really growth, inflation, and the Fed's policy reaction function to those things. And I really try to dispense with a lot of the noise that comes in the macro space about this indicator, that indicator, or the banks are doing this, the banks are doing that, and whoever's doing what. A lot of it ultimately doesn't matter. Those things are all really residual and not causal. What really drives asset prices is earnings and the interest rate at which those earnings are discounted. So I really just try to focus on those real core fundamentals and keep those things in perspective.
Yep, clear and focused. Yeah, I think it's so important as traders, like you said, investors. We don't have a ton of time. I need to know clear direction. What's the theme, and how to go out and execute it. And everybody out there listening, go and check out David's Substack. David, where can people go and subscribe to your Substack, and also plug where people can find you on X?
Yeah, so the Substack is pinebrookcat.com, all one word, pinebrookcat.com. And on Twitter or on X, it's EconStratPB, EconStratPB. And that's my public feed.
Yeah, David, you're a great follow. I'm glad I got introduced to you by our buddy Donnie.
Yeah.
Donnie was recently on my show. Donnie's the best. And, he said, Anthony, you got to go follow David. So I'm telling everybody out there, you guys got to go follow David. He does a tremendous job. And David, it was great to be able to get a chance to meet you and speak with you today. Thank you so much for coming on the Futures Radio Show podcast.
Hey, thanks for having me, Anthony.